After a week of data pointing to a soft landing, is it almost time for the Fed to cut? Welcome to Market Insight. I'm Elena Casas. Consumer prices rose more slowly than expected in April, while retail sales failed to grow at all, in a possible sign Americans are pulling back. That's the kind of data markets had been hoping to see, and traders have increased their bets on a rate cut in September to around 70% from even odds at the start of the week. Fed policymakers, though, have been reluctant to say anything concrete about when rates might fall. Well, to dig into this week's data, I'm joined now by Gregory Daco, chief economist at EY Parthenon. Greg, if we look at some of this week's data, especially that flat retail sales number, is it showing us actually that some Americans can no longer afford to spend amid higher prices and higher rates?
I think it certainly does indicate that there is more scrutiny, more prudence on the part of consumers, especially consumers at the lower end of the income spectrum. Those are the families that are most likely to be affected by the high cost of goods and of services, and they are also more susceptible to the higher cost of interest. So the combination of this environment where cost levels remain elevated and where interest rates remain elevated is constraining consumer spending momentum. We're not seeing any signs of a retrenchment because the labor market remains robust, but we are seeing increased evidence of a cooling of consumer spending momentum, which in and of itself should be disinflationary.
What about the impact on the US housing market, which still seems frozen in this week's data? Are rates shutting people out of home buying?
Well, I think it's certainly the case that for first-time home buyers or individuals that want to buy a home, the high interest rate environment is indeed a severe constraint. But for the broader market, we are in this unusual environment where we've seen a lot of families essentially lock in mortgages at very low rates over the course of the past 3 years. And that is preventing movement in the housing market. As a result, you have this lock-in phenomenon where you're not seeing as much movement and inventory remains quite tight. That continues to push upward on prices, and you have this combination of elevated prices and elevated interest rates that are constraining affordability and pushing it to the lowest levels that we've seen since the 1980s. So right now, the housing market is still very much frozen and in big need of additional supply.
Should Fed policymakers then be more worried about the growing divide between those who do and don't benefit from these higher rates?
I think we have to be very careful at this juncture because we are seeing signs that the economy is gradually cooling as a result of this higher interest rate environment. And indeed, if you look at the debt burdens across families, if you look at the latest readings in terms of delinquency rates and transition into delinquency rates, you're seeing that for credit cards and for auto loans, the younger generation, as well as lower income families, are increasingly struggle to make ends meet in this environment. So the Fed should be very careful that with its eyes focused on ensuring that inflation comes back down to 2%, it does not press too hard on the monetary policy brake so that it creates more pain that is needed in terms of higher unemployment, lower job growth, and in turn, a potential pullback in consumer spending activity.
Do you think the data then is building a case for a sooner cut?
Yeah, I think there's certainly the opportunity for the Fed to ease monetary policy earlier than what markets are currently pricing as of September. We think that there's still a possibility that a slower inflation environment, as well as an environment where you see easing labor market momentum, could offer the opportunity for the Fed to start easing monetary policy in July, do so gradually, and then proceed with another rate cut in November. So we still forecast 2 rate cuts for the Fed over the back end of 2024.
What do you make of the reluctance of Fed policymakers to publicly even hint at a cut in September, never mind earlier?
I think they want to be very careful. They want to err on the side of caution because inflation has been so potent and so persistent over the course of the past 3 years. They want to avoid, by all means, a situation in which inflation would reaccelerate. So as policymakers, they're likely to err on the side of caution and delay the onset of their easing cycle until they're very confident, very sure that inflation is moving sustainably down towards 2%. That will be a delicate exercise over the coming months because we foresee somewhat of an inflation plateau, or PCE inflation, which is the Fed's main gauge, around 2.7%. That's going to be very difficult to navigate from a communications perspective from the Fed, but we still think all of the right ingredients are present when it comes to disinflation. You have moderating final demand growth, you have easing rent inflation, you have slower wage growth, and you have stronger productivity growth. Combine all those, and disinflation should be what we expect over the course of the coming months.
Gregory Daco of EY Parthenon, thank you so much for that analysis. Well, that's your market insight. You can watch more videos on Reuters.com.